Hello there, M&A Advisor community. This is Roger Aguinaldo, and welcome back to the M&A Advisor Podcast. Since 1998, the M&A Advisor's mission is to recognize achievement, provide thought leadership, and connect professionals in mergers and acquisitions for the purpose of improving your deal-making craft and accelerating your deal flow. Whether you're an aspiring deal maker, a seasoned professional, or just curious about the world of mergers and acquisitions, you'll find something valuable and relevant in our podcast. And now for today's podcast. Hello, M&A Advisor community. Welcome to the M&A Advisor Podcast. I'm Roger Aguinaldo, the creator and CEO of the M&A Advisor. The M&A Advisor is the preeminent organization that recognizes excellence, honors achievement, presents thought leadership, and facilitates connections among the world's leading mergers and acquisitions, restructuring, and deal-making professionals. Join me as I talk to the best of the best in the M&A, distressed investing, restructuring, and finance industry. Hold on to your seats because you are in for a treat. Today on our show, we are very honored to welcome our special guest, a longtime friend of the M&A Advisor, and a Lifetime Achievement Award recipient, member of our Hall of Fame, Wilbur Ross Jr. Hi, Wilbur. How are you? Okay. For those of you who don't know Wilbur Ross, I'm going to give you a little bit of his bio. Wilbur served as the Secretary of Commerce in the Trump administration following 55 years of experience in investment banking and private equity. And in this capacity, he advised President Donald Trump on commercial and economic affairs and helped American entrepreneurs and businesses create jobs and economic opportunity. Wilbur's a native of North Bergen, New Jersey, where he spent a significant portion of his business career at Rothschild, Inc. Wilbur negotiated on behalf of creditors in some of the highest profile bankruptcy proceedings in history, including those involving Pan Am. You remember Pan Am, TWA, Texaco, and Drexel Burnham. Remember Drexel Burnham? After founding his own private equity firm in 2000, W.L. Ross and Company, Wilbur purchased and restored many companies to profitability, including those in steel, coal, textile, and the banking industries. And over the course of his career, Wilbur restructured more than $400 billion in assets, earning him a distinguished reputation on Wall Street. 2011 Bloomberg Markets named him one of the 50 most influential people in global finance. M&A Advisor has recognized Wilbur with a Lifetime Achievement Award. He's been inducted into the M&A Advisor Hall of Fame. And outside of business, Wilbur has philanthropic work, which has included significant support for the Japan Society, the Brookings Institution, the Blindheim Foundation, and numerous entities devoted to the fine arts, including the René Magritte Museum in Brussels. He's also an advisory board member of the Yale University School of Management. Wilbur is a graduate of Yale and Harvard Business School, and he and his wife, Hillary Geary Ross, have 4 children. And may I add on that he also graduated from Xavier High School in New York City, a nice private Jesuit high school in which actually my son attended as well. I think I read in your upcoming memoir too, Wilbur, you were on the rifle team, right? You were on the rifle team over at Xavier. So just to set the stage here, and we're gonna talk a lot about Wilbur's early career, how he got into finance, why he got into finance, why he chose that as a career. Fast forward through his numerous achievements in deal making, and then of course, from 2017 to 2021, his time as Commerce Secretary under the Trump administration, and then back to deal making. But back in 2000, just a personal story to share, and maybe Wilbur knows this or maybe he doesn't. You were on the cover of Business Week and you were hailed the king of bankruptcy. And we were just starting our conferences and events. And I think I said, here's a list of 20, 30 people that we would love to have as a keynote And I called all of them, and your name was on it. And then after that was an exhausting 2 or 3 days just leaving voicemails. Back in the day, people didn't answer emails. Everything was on the phone. You had a call. It was smile and dial, right, Wilbur? Everything was smile and dial. And I left a message on your voicemail to, "Hey, we have a M&A conference that's in New York in October. We'd love to have you speak." And then crazy enough, you called back, left a voicemail. Now, for those of you who are too young to know, people left voicemails back in the day rather than texting or emailing. Wilbur left a wonderful voicemail saying, "Hey, I'd love to be one of your keynotes, love to speak at your conference in mergers and acquisitions. Tell me some of the details, and I'm in." And that's basically it. And that was, I think, more than 22 years ago, Wilbur. So thank you for certainly answering the call, returning the call, and then certainly speaking at our events. And he spoke numerous times. He has hosted us in his home down in Palm Beach for our distressed and investing and turnaround awards events, and has advised myself and the M&A advisor over these last, now we're in our 26th year, Wilbur. Thank you for joining our podcast. Thank you for answering the call 20 plus years ago and being a great support of the M&A advisor. So we're just going to jump right into it. Early in your career, you're at Xavier High School, you go to Yale, and then you decide finance on Wall Street, or what did you do before then, and why did you decide to go into finance? And if you weren't doing finance or Wall Street, what else could you be doing or would you be doing?
Well, that's a whole lot of questions, Roger. I'll try to deal with.
Well, they're gonna have to buy your memoir, right? We're gonna have to read the whole.
Right. That's for the real inside information. Now, my first real summer job was a very bad introduction to capitalism. I was a car parker at Monmouth Park Jockey Club in Oceanport, New Jersey. And the first day, Louis, the lot boss, got all the kids together and said, "Here's what's going to be happening. There'll be a lot of car accidents because you're in a rush to get people their cars back. And if they notice the accident before they leave the track will have to pay the insurance and you will be set down for a week." So he then described in great detail how to distract the car owner from the fact that his car was bashed up. It was the first time I'd worked for more or less a real company. And I thought, holy smoke, guy's advising us how to gyp his customers. So it was not a good introduction. I later came to learn that this was quite an unusual thing, and American honesty and integrity in business probably far better than that of almost any country in the entire world. So that was a weird introduction. Anyhow, then I'm at Yale.
Yeah. Did you make tips? Did you make good tips though?
Yeah, we worked for tips, but he also said, if you want to supplement your tips, you can buy a concession from me. But a concession in a parking lot, what on earth could that possibly be? Well, what it was special places to park the cars. And this had nothing to do with the track authorities. This fellow invented these concessions on his own. And so one would be parking the car under trees. You would be amazed, but how many people leave little children and or pets locked in the car for 6 or 8 hours while they're at the track on a boiling hot summer day. So that whole experience was a little bit otherworldly. So then I'm off at Yale, and one day I got a call from the faculty advisor to the fraternity of which I was the president. And he said, "What are you going to do this summer?" I said, "I'll go back to being a car parker, just like I had been before." And he said, "No, I'm leaving the university's endowment. I'm going to a investment boutique in New York, and you're going to come with me as my clerk. So you don't waste your time parking cars, but you get to something that could live a future." So I showed up there, and it was a total contrast. The main partner was a man called Pete Buckner, very religious man. And the only bad thing about the job was I had to get up at 6:30 every morning, leave my parents' house, come over to New York City, and listen to Mr. Buckner read from the Bible for a little bit. And then we would meditate before we went on to the day's work. So it was a total contrast from before. Turned out they were mainly turnaround investors. And so that was how I got a little bit of a start, but they were passive investors. They were portfolio people. They didn't actually make the turnaround, but they certainly benefited from it. So that was a taste that you could really make money in all these troubled securities. Later, I finished Yale, and between Yale and Harvard Business School, worked at JP Morgan and the first in their trust department. And the first assignment they gave me on my own was to go to a closing at the famous William Zeckendorf's office. He was a well-known real estate speculator. And what I was there to do was to gather up a 13th mortgage that one of the bank clients was getting back for some transaction he'd had with Zeckendorf.
13th mortgage, you mean the 13th in line mortgage or the third?
13th, yeah, 13th in standing.
Oh, wow. Okay.
And at the time, I couldn't even visualize a fifth mortgage, let alone a 13th.
Right, right.
But while I got there very early, and while I was waiting for Mr. Zeckendorf, up came this big bear of a man carrying a little Chihuahua dog. And he put his arm around my shoulder and he said, "Well, young fellow, you look a little troubled. What's the matter?" And I said, "Oh, nothing, sir. It's just I've never seen a totally circular office before. It was a very round space, 360-degree view of New York." And he said, "Well, let me tell you, if you had been backed into an effing corner as often as I have, you would have a round office too." So a year or so later, he went bankrupt, but by then I was back at school, so I wasn't able to get involved. So graduate from the business school. And
So then you went to, so after that experience, the company went bankrupt and you said, well, I might as well go to Harvard Business School now.
so I got a job with a go-go money manager, a fellow called Emery DeVay. And when I was just about to leave the Army and join the firm, he died. And on his deathbed, sold the firm to one of his clients, Robert Winthrop, from the Massachusetts family. So now I had changed jobs without even getting a paycheck. Just the man died and he had a successor. A few weeks later, Jack Dorrance, who was the controlling shareholder of Campbell Soup, came in along with his pension fund people, and they were trying to check out the new owner of the firm. So they said at one point, "Bob, why do we have so many shares of Lucky Friday Silver Mines in our portfolio?" Mr. Winthrop turned to me and said, "Wilbur, do I have those shares too?" And I explained, "Yes, sir, all of our accounts have the same percentage participation in it." I explained why. Dorrance then said, "Well, thank you, I understand it. the following day, he pulled all the accounts out because it was clear that this was not the same kind of manager that he had had. So Mr. Winthrop then decided he didn't like this business so well, and he merged the firm with Wood Struthers.
Money management, the money management investment.
Yeah, he liked better being a client than being a proprietor. So he merged with Wood Struthers, and it became Wood Struthers and Winthrop. They were a very conservative firm, and they didn't like the venture capital business that we had. So they took me as the most expendable person and gave it to me to work it out, run off the portfolio. And they gave me 2 years to do it, said I would get a very good bonus at the end if there was no litigation and no new money had to be put in by them. So it worked out very well. Then when
How big was this portfolio? Remember how big the portfolio was at the time?
Yeah, and there were all kinds of things in it. Some were very good, and we sold them for a big price. Some were just things that never should have been invested. But it taught me how to do workouts with the bank because we had about 40 names in it all together. Then I went to work for a conventional research firm, Faulkner Dawkins and Sullivan, doing airlines, and that worked out very well. And we were a very prosperous firm. But then along came negotiated commissions in the mid 70s, and we went from having a 40% gross net profit margin and making 100% on equity to a very modest rate of return. So that's when I left and joined Rothschild. They had been clients at Faulkner, and there ran the investment bank in New York and concluded as we watched what was happening in the junk bond market that the advent of deliberate junk bonds had to mean one main thing, and that was that there would be a lot more workouts of them. So started to develop a practice of organizing the creditors to unite and present a concerted front to mostly Drexel. Drexel in those days must have been a 90% market share. And once we broke the ice and created a situation where the bondholders were unified, the fees all got paid by the target company. So for bondholders, it was a great deal, cost them nothing to get professional advice. So that built the business very, very well. And we diversified it from just doing creditor work to doing equity work, representing companies, going the whole 9 yards in the process. And ultimately, strangely enough, when Drexel went bust, we represented the unsecured creditors in the Drexel bankruptcy. And that was quite a challenge.
Yeah. Kind of full circle there, right? Because you were working with Drexel and Milken and all those folks, right?
Yeah.
Yeah. Yeah. So Pan Am, TWA, Texaco, all of those workouts and bankruptcies, you also now did you represent the creditors on those bankruptcies as well?
In the case of Texaco, we represented the equity committee.
Okay.
Texaco is a very unique bankruptcy in that it was a very profitable business with a very good balance sheet. But there had been a company called Pennzoil that had made an agreement to acquire another oil company. Texaco interfered with that and got the deal away from them. They brought litigation and they won in the Texas court. And Texaco's lawyers, unlike most damage cases, did not put in expert opinion as to what would be the damages if they were found guilty of the charge, which was tortious interference. That proved to be a very big mistake because the Texas court found against Texaco. And now the only testimony that was in the record was the testimony of Pennzoil's advisor, which said it was billions of dollars that it cost Pennzoil. So Texaco appealed to the Texas Supreme Court, lost there, and now filed an appeal with the U.S. Supreme Court.
Yep. Very famous case.
And to protect themselves while that was pending, they filed for a Chapter 11, because in a Chapter 11, any pending litigation is stayed until the bankruptcy is resolved. So by then, with accrued interest, the judgment had gotten to be around $10 billion, which would have been highly dilutive to the Texaco shareholders. So the Texaco Equity Committee, the largest of which members was Carl Icahn. Carl was a very big stockholder in it. And we tried to get Texaco to agree to settle it because the Supreme Court takes relatively few cases and half the time upholds the decision anyway. So we tried to convince them they wouldn't do it. So I arranged for us to go see Pennzoil, and we, as the equity committee, worked out the deal with Pennzoil to pay them a little over $3 billion. And that was the most that Texaco could afford to pay without diluting the equity. So it was a very important number to our committee. This made the Texaco team very angry because they wanted vindication and they were convinced that this was a very unfair decision that had been lodged against them. Anyhow, it got settled, and the bankruptcy court approved the settlement. Shareholders approved it. Carl tripled his money, so everybody was happy. And that's one of the things that people should carry away from bankruptcy. Not every case is as unique as Texaco, but every case is unique. And there's some aspect of bankruptcy law that, if addressed properly, can be used to your advantage in that one-off situation. So that's one of the things that people need to realize. The other thing they need to realize is you really can't let emotion get in the way of the settlement. I can understand why the Texaco management was upset. They really felt they'd done nothing wrong. But if it was a question of potentially losing $10 billion and getting diluted to death, or just paying $3 billion odd and having no dilution, we felt that was a fairly easy arithmetic call. In its own way, that was unique. Drexel was unique in another regard, in that they had been, in the early days, the most profitable firm on Wall Street. They were earning over $500 million a year net. Then,
And that was in the 80s, so this was a heck of a lot of money.
Yes. Oh, that was real money back then.
Right now, that's like a month worth of debt on the interest.
But anyhow, so then when the junk bond market collapsed, Drexel had to file. And because they were so leveraged, and in many of the securities that were in their portfolio, they were the main market maker. So their demise collapsed the securities to a very bad price. Well, what that meant was it would likely have to be a liquidating Chapter 11 rather than the normal Chapter 11 where you convert some debt to equity, get rid of some claims, and you recapitalize the company, and it reemerges. Well, here, it wasn't going to be able to reemerge, but in order to preserve,
Reputation, its reputation was so bad. Milken went to prison. Everybody was looking for the exits, right?
yeah, so what we had to do was get the court to agree that we would create a new company with a new management. It would hold the bulk of the portfolio and hopefully work it out over a period of years. And it did. So it was a unique thing in that Drexel never reemerged itself. All that reemerged was a special purpose holding company having the assets, and they eventually got 70+% recovery. So it turned out to be good. But again, the idea was each case is unique. Each case has some unique aspect of bankruptcy law that's particularly relevant to it.
So I want to go over how you go from an advisor at Rothschild into your own private equity firm. But during that time period, you also represented the creditors in some of the Trump casinos, right? You represented, and was this the first time you met Donald Trump back in the 80s?
Yeah, it was the first time I met him commercially. I knew him slightly from New York social circles. And that too was a unique case in that the casino financed its inception from ground zero, both with trade credit and with an $800 million first mortgage lien. It never paid one coupon on the mortgage. As you pay a coupon every 6 months, this didn't make one single payment. So naturally, the creditors were furious with, in this case, they were mostly insurance companies who were buying subprime paper. So we had a very public,
During the underwriting, couldn't they see the cash flow? I mean, again, most of our listeners understand all of this stuff, right? The cash flow, all of that. So something must have went wrong in the underwriting process.
well, there was no cash flow because it was still constructing the casino. So it was literally, it was the first mortgage financing of a start. They didn't sell any equity. Trump had all the equity. Instead, they sold 800 million of mortgage bonds. Now, how they got people to buy them, who knows?
Trump is a tremendous promoter, right? So he's
Yeah, yeah. So, anyhow, we had a very public, very acrimonious bankruptcy. And strangely enough, Carl Icahn was also the big bondholder in the Trump Taj Mahal. So we had worked together before in the Texaco, and so we knew each other pretty well. And eventually, we got to a solution with Trump where we got the old interest, the unpaid interest, we got full principal amount, and we got a minority of the equity. So the holders came out pretty well, but it was a very strange bankruptcy because it went bankrupt before it ever really had a business, just as it had financed before. Once again, the thesis: everyone.
well, then that's how they built the equity through converting the debt into equity. It sounds.
No, we didn't. We got the equity as a kicker. We got the full principal amount of the mortgages. We wiped out the unsecured creditors and got 40 odd percent of the equity. And that was another principle of bankruptcy, figuring out what your adversary really needs as a bottom line to have a consensual deal. And in this case, the key was Trump wanted to keep majority ownership of the company. So we put some independent directors on, put some limits on what he could do, but he ended up in control of the equity. And he got out from under any personal liability. Remember, it was a partnership that had issued the bond. So,
Oh, he was personally liable. He was personally liable. Yeah.
so as well, conceivably, there was another layer between him and the public, but he was at risk of possible individual liability, but he was certainly at risk of losing control, losing all of his equity. But we had concluded that because his persona was so well defined with the public who were his gamblers, we felt that the casino would be worth more with him remaining in control than it would if we knocked him out of the picture. So that took a lot of convincing of the bondholder because you can appreciate how embarrassing it is. You're some big insurance company and you bought a big bunch of bonds and never got one coupon. So there was some,
Or Carl Icahn. You can't roll over Carl Icahn. So pretty tough too. So
no, 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 no. So that as I say again, it had unique characteristics as a banker.
well, that fascinating. Those are just fascinating stories. Let's transition now. I mean, I think we just went over about 35 years of life in 10, 15 minutes, but this is even probably your, if you will, the second part of your career, if you will, which is still in finance Wall Street, but into private equity, right?
Right. Yeah. Well, the way that came about was this. We had a very good advisory market share, and our fees had gotten to be quite big per month. So that meant that smaller companies could not afford to hire us because there wasn't enough value in the whole system to justify those fees. So we decided to start a private equity fund called Rothschild Recovery Fund. And its purpose in life would be mainly to buy into bankrupt businesses that we were not in a position to advise, either because we lost the competition, although that wasn't too often, or more often because they were too small to afford the fees. So we now had two ways of participating in the bankruptcy process. Same team ran both. Now, obviously, you couldn't be an investor in the company you were advisor to, so they were separate in that sense, but it gave us a broader scope.
Right, right. For the conflicts and bankruptcy bankruptcy doesn't allow you to laws.
Right. You can't be another interest holder. So it gave us another whole mechanism for participating. Then we did that for a couple of years. And then there was some management changes in the Rothschild group. And the incoming CEO and I were quite incompatible. So we worked it out that I would buy the business that I had created, namely the investing business, from them. I would agree not to continue in the advisory business, just to do the investing. And so at age 61, I became literally an entrepreneur, kind of a late bloomer in that sense. And naturally, we couldn't.
Remember a press release, if I remember a press release from 20 plus years ago, I think it said you began it or announced it on your birthday, which I believe is April 1st. Am I right with that?
No, it wasn't my birthday. No, what it was, I felt that for a 61-year-old to give up a very high paying, very secure job in favor of being a speculator in what was then a fairly small private equity fund. That first one only had 300 and some odd million in it. So I felt April Fool's Day was the right time to do it. It would have been real happenstance if it were the birthday as well. So that was technically a change in control. And so we had to solicit the investors because they had the right to redeem. Every single one stayed. My entire team stayed, even the guy who ran the mailroom. And then we went off on our own. And then years later, when we had gotten quite a bit bigger, Invesco made an acquisition bid to us. And that was an unusual transaction in itself, in that Invesco is a $1 trillion investment manager, mostly relatively open market paper, especially at that time. And they wanted to try a little bit of alternative investing. So we worked a deal and they acquired it. And it worked fine. They made some money out of it. We made some money. And when I went into government, obviously had to sell that hold. So that ended it. And meanwhile, I had been gradually transitioning the control over. I had become just as chief strategy officer, not the CEO. So that was a very nice transition into government.
Yeah. And then also you were doing a number of fairly large financial services deals. So tell us about that transaction. I think that was a pretty good one for you.
Yeah, well, the first one we did was Bank United, which was the biggest bank in Florida, biggest independent. This was during the subprime mortgage crisis. And they had a portfolio that was really terrible. Their specialty was 95 to 100% loan to value ratio loans to non-resident Latin American borrowers buying a vacation property in Miami. You can imagine what a toxic portfolio that was. So we and Toronto Dominion were literally the only bidders in the bankruptcy, but it was a quite large transaction. And so I joined forces with Blackstone and Carlyle. We each went one third, one third, one third. And 18 months later, it went public in the biggest bank IPO in the history of the country. So it was a very quick workout. And then we did Bank of Ireland. We did Northern Rock in the UK with Richard Branson, Virgin Money. We did a bank in Greece, Eurobank. We did the Bank of Cyprus. We did some banks in the Midwest. We did some banks in the Pacific Northwest. So we, during that period of the sort of 2008 to 2010, 11, much of our activity was financial. We also had bought the third largest subprime mortgage servicer. We had concluded that while the origination business obviously had gone by the boards because the defaults were so high, but the servicing was still a good business. So we bought the servicing part of a bankrupt mortgage originator. So we were doing a lot of financial services. You were quite right. And that's the other thing about bankruptcy, at least bankruptcy investing. Just as in the normal public markets, things go into favor, they go out of favor. In distressed investing, industries tend to go bad as an industry. Think about it. At one point, it was all the retailers. At another point, it was all the airlines. Then it was a lot of financial institutions. So you have to be a little bit agile and notice that it's changing. Notice that where the demand for bankruptcy advice is coming from is changing, and you've got to staff up with specialized knowledge, particularly with highly regulated industry like the banking industry is. So there are a lot of lessons to learn, but the idea, look for the uniqueness, look for.
Yes, we're going to transition sort of into politics and government in your sort of part 3 or chapter 3 of your career. But for those who are listening, and we're sort of more M&A deal maker audience here. What industries are you looking at? Would you be looking at? What are the things that you're seeing out there right now?
Right. Well, right now I don't have a fund and I don't have an advisory firm. So
You do have are you working with a SPAC right now though, right?
yes, but that's a whole different thing. I think right now the big glamorous thing in the public market is high tech. For the moment, it's artificial intelligence. 2, 3 years ago, it was biotech. Biotech now is way out of favor. There are lots of stocks that went public at $10, $12 a share, now trading 60 cents, 80 cents, a dollar. Some of them, at least for at a point when I was buying, some of them were trading for less than their net cash. So you were getting the whole science component for free and getting more cash with no debt because these very young companies really don't have meaningful debt. I think there will be further opportunities in high tech.
You think like in crypto, blockchain, any of those types of things? Do you run?
Well, I'm a big believer in blockchain. Blockchain is already kind of transforming a lot of financial services. It's very real. I've always been skeptical of crypto, and that cost me a lot of money because I never bought one coin or one share of a crypto promoter. So I don't know if I'll ever be right that it isn't real, but I just don't like to invest in things that I can't quite understand. And I don't quite understand what the charm is from.
We're a long way from the gold standard. Right. So let's transition. This is just a great conversation thus far, and appreciate your time. We're on with Wilbur Ross. Let's go right into sort of chapter 3 of your career, which is politics. Now, you've always been a contributor to politics. You're married to a former lieutenant governor. I mean, you've been, in and around politics. You've raised money for both Democrats and Republicans. I think you supported George Pataki, right? Or maybe, yeah, I think you did, right? And then of governor of New York. And then, of course, you supported Trump, and then Trump selected you as Commerce Secretary. I have one sort of basic question regarding Secretary of Commerce. And look, I think I'm a pretty educated guy and all of those types of things. What does a Secretary of Commerce actually do? Let's just like let's go to those basics. And what are you supposed to do? And did you expand that role when you were working with Trump?
Sure. The Commerce Department is one of the most complicated departments. We have everything from big responsibility for trade policy, export controls, tariffs. We're the ones who originated the steel and aluminum tariffs, to the Weather Bureau, to the National Institute of Science and Technology,
Oh, I didn't know that. Oh,
to operating 17 satellites, to the census, to the Minority Development Agency. Need not go on, goes on and on and on.
yeah. Is the SBA under that? Are you SBA? Is that under Treasury?
No, no, that's separate. Separate.
Yeah, that's under Treasury.
But we have the minority development. We're also the telecom advisors to the president. So it's got an extreme, when we were responsible for commercializing space. So it had a very wide portfolio. And what was especially intriguing was that the 2020 census would be coming up during the Trump presidency. That meant we had to go from a little bit under 50,000 employees, which is quite a few itself, to hiring another 400,000 temporary part-time workers
Wow.
to take the census. That in and of itself it was an enormous management challenge. And it became even more so because you take the census as of April 1st. This April 1 keeps recurring in my life. So as of it,
And it- what 2020, right? Pandemic.
yeah, in 2020. So that's right when COVID hit. So now we had to hire the 400,000 odd people in the face of COVID, get them personal protective equipment, convince them that it would be safe for them to go around door to door taking down the information. So it became an incredible challenge. And then it became a big litigation because I wanted to put the citizenship question back on the census. It had always been on, got taken off a couple of presidents before us, and that became very litigious. So that,
Was it on? Did it go on?
no, it did not. Did not. The
Oh, it did not.
Supreme Court ultimately said we couldn't do it. In a sense, that was a disappointment. But we did enumerate 99+% of the houses, despite all the problems of COVID, litigation, and everything else. So I think that was a major achievement.
Yeah. Yeah. And the census is used a lot of it is used for government funding,
Oh, yeah,
appropriations, lots of different, a lot the redistricting,
yeah, yeah.
right? They're also do some redistricting utilizing that as well.
Now, yeah, 40% of all the factual information that's put out to the public by the federal government comes from census.
Yeah. Yeah. Wow, that's amazing. So let me focus on one of the things that I think Trump talks about even today, which is sort of the tariffs they put on the imports. A lot of people see that as protectionist and an isolationist for America to be doing that. It's really leveling the playing field. Let's see what it's really all about. I think that's a very big accomplishment from you and the administration. And look, maybe 100 years ago, it's protectionist and isolationist, but with the internet and with air travel, we're always going to be a global, country, right? It's just really leveling the playing field on and services that we import.
The idea of the tariffs wasn't to be isolationist, but it was to deal with things that countries were doing that they shouldn't have done. There really is no such thing as free trade in today's world. Every country has trade barriers, both tariff barriers and non tariff trade barriers. So this was merely meant to offset those and to protect our industries. It was protectionist in that sense, but I don't think protectionism should be a pejorative term. What better duty does government have than to protect its citizens? What better duty and commercially than to protect its business? What better duty in terms of labor market than to avoid his companies being inappropriately put out of business?
Yeah.
So, well, it became a very negative term. It really shouldn't have been.
I think Trump's making that case. I think his vice presidential pick is going to make that case as well to protect not only American interests but American workers. So I think they're making that case. I think it's a rational case, and I think they hopefully succeed in that. Two questions regarding Trump, and then we'll go into your memoir, which I've read it. It's a fascinating read. A lot of great stories in it. A lot of deal makers listening to this podcast, when the American public says, we want to vote for a businessman, we want to vote for someone who runs with it. Most people, I guess the common people who think businessman, they're just looking at profit and loss and all that. But sort of businessman, entrepreneur, they're deal makers, they're negotiators. Trump makes the case that, look, I'll go over to Putin, I'll go over to North Korea, I'll talk to anybody just to sit down and negotiate and talk to people. Describe Trump as a deal maker, negotiator. Describe your experience of him with that.
Well, it's interesting that even though both Carl Icahn and I first really got to know him under very adverse circumstances, namely his company's bankruptcy, we both came away supporting him for the presidency. That tells you a lot, because when you encounter someone under very, very bad times, you get to know what they're made of. And we both concluded that what he was made of was something that's important and useful and good. Think about it this way. Whatever else people may think about how he ran the Taj Mahal or anything else, he is the only person in the history of the world to make himself a personal brand name in real estate that's global. His name on a building, whether it's in South Korea or it's in France or it's in US or it's anywhere, sells the building for a higher price than it would have. That in and of itself, if he had accomplished nothing else, that in and of itself would be a monumental achievement. Now, he's got plenty of other achievements as well. And I think in terms of his presidency, the biggest single achievements were the economy was humming, unemployment was very low. The biggest problem businessmen would come to see me about was they couldn't find workers. But we didn't have inflation out of control the way it got to be later. So that was one set of accomplishments. The other one, if you notice, there were no real shooting wars during Trump's whole 4 years because people were a little bit afraid of him. They felt he was a little unpredictable. He might really smack out at them, and nobody really wants to be the most mortal enemy of the U.S. So he played that brilliantly. You'll contrast that with what has followed. We have wars all over the place, and we're being extended on many different fronts. So I think those were the signature achievements of the Trump administration. And the border. He had the border under control. So there was a huge sea change from what had come before, and certainly a big sea change from what came subsequent.
Yeah, yeah. So what would the next Trump administration, assuming that he gets enough votes this time or gets the electoral college this time, what would the next Trump administration look like? And will you, Wilbur, be participating, or you're going to be, doing anything within the administration?
Well, as to the second question, let's just get him elected. It's a little early to divide up the spoil. In terms of what it will be like, I think it will be mainly restoring the country to where it had been, getting the border under control, getting the inflation truly under control, because a lot of the inflationary problem comes from the administration's anti-hydrocarbon policy. And while the Federal Reserve doesn't like to count the price of fuel or the price of food when they're calculating inflation, I can promise you the average American citizen counts both because they are a big part of his pocketbook. So I think the first order of business for the administration is to get us back where we were under Trump. That will be a huge achievement in and of itself. Now, fortunately, a lot of the damage that was done under Biden was done by executive order, and that's good in this regard. Whatever was done by executive order can get undone. So I would guess in the early weeks of the Trump presidency, you're going to have whole forests of trees mowed down with new executive orders. Trump had put in a rule for the cabinet department. If you want to propose any new regulation, you must couple it with elimination of at least two of comparable size. So you could not put in net more regulation. Our department actually canceled 8 for every one that we put in, and so did many other departments. And I think when history finally has the distance of time, I think they will recognize that even more important than the tax cuts were the deregulation. And that will clearly come back in.
You guys did an amazing job just in the 4 years that you were there. A number of people like, oh, it doesn't matter who you vote for, who don't. I mean, just look at the past 3.5 years. It does make a difference who the president is.
Makes a huge
Makes a huge, huge difference. So look, crossing fingers where I know where you stand on things, but we're all for you in that. So now let's get to your memoir. Listen, if you've been following the M&A Advisor, you may already know that one of our missions is to provide thought leadership to M&A, restructuring, and deal-making professionals. Wilbur Ross is exactly that icon in the M&A industry and a thought leader to be looked up to. You're coming out with a memoir this fall, Risk and Returns, Creating Success in Business and in Life. And in our September event, we're going to be recognizing emerging leaders. These are leaders under the age of 40 in the deal-making space. We're going to scores of professionals and individuals who are in their early parts of their careers, before the age of 40. So I think this memoir could be maybe your roadmap to success and where you've come in. What are some of the lessons learned that you can share with them? And I think that's why you wrote this book is, right, to share these.
Yes. Well, part of the reason for writing the book was young people. And I'm very gratified. Yale School of Management is distributing the book to every single student. Harvard has an undergraduate course in entrepreneurship. They're using it in that. And Ed Altman, the famous bankruptcy professor at NYU, is using it in the bankruptcy courses at NYU. That to me is what it's not a textbook, as it's written more like a novel, although it's quite factual, not fiction.
And if you come to any of our summits in the fall, Wilbur, we'll have your books at our summits as well to the guests, to our registered guests at our event, and you'll sign them too.
Yes, yes. But the usefulness of the book, I think, is not just young people. I think a lot of our population has become very anti-work. In fact, I encountered a Reddit with 6 million subscribers that is just anti-work. And you see pathetic things on it. People, not just kids, but 40-year-olds in what should be their prime of life, saying, I just can't force myself to go to work anymore. So the notion that hard work is something strange, is something weird, something to be avoided at all costs, that's the worst thing from the point of view of what used to be the American dream. The other thing about it that's probably quite related is that people have gotten very risk averse on a personal basis. You say something that upsets them and they go run to a safe room. I don't know how people who think like that are ever going to run businesses, or especially how they're ever going to run the country. So this is meant to say the only thing that can really hold you back is you yourself. If you're willing to face up to the challenges that we all face and deal with them and recognize that sometimes you won't win, sometimes you'll have a big setback, and you just have to learn from that and go on. You also have to take some career risks, like I did at age 61, going out on my own with a fairly big payroll that I had to cover, as opposed to being a partner in a very well established business. You got to take a little bit of risk. Without risk, you limit your opportunity. Now, it can't be nutsy risk, can't be betting on horses or something.
So you say in the book, don't be afraid to take rational risks, right?
Right, right.
Seize the opportunity within the challenges, never assume anything, verify everything, adapt to circumstances, evaluate and tolerate risk, and summon fact-informed courage.
Yeah. In fact, one of our mantras when we were doing the distressed investing was we wanted to take perceived risk as opposed to actual risk, because perceived risk the market will pay you for by discounting the value of the paper, but you don't necessarily get paid any more for taking actual risk than you do for taking what people somewhat misperceive as too much risk.
Yeah. So listen, we're really over time, which is great. We're gonna obviously. Wanted to leave with our young leaders. If there's any other lessons you think they should be looking into and continuing the career, because a number of them in their 30s, right? They just may decide to leave the career, right? So any suggestion to for them to continue and what do you think they should be doing?
Well, they should go on Amazon and buy my book, Risk and Reward. It's the best $32 they'll ever spend. And if they do that, and if they take some of the lessons in it seriously, I think they'll make thousands of percent return on that investment. And it might be a good start into taking a small risk that can very well turn into a big gain.
Well, even better, they can come to an M&A Advisor Leadership and Dealmaking Summit on September 23rd and 24th, and you'll be speaking. You'll be one of the featured speakers at our leadership event. And then we're going to probably talk about leadership, mostly leadership, and your book there. You'll also grace your presence at our November event, and then down in Palm Beach for the distressed investing and turnaround, in which Your book will be available. You can't wait. We're going to put a link right into this podcast where you can get Wilbur's book, and that comes out in the fall in September.
Yeah, September 10th.
September 10th. Okay, terrific. Wilbur, I know we spoke about a lot of things. This has been an amazing podcast, probably one of the best thus far that we've done this year. To have you, is there anything that we didn't cover that you want to talk about, or perhaps share something, one of the things you're working on right now for the future besides your book? I mean, your book is going to be, I'm sure, is going to be a bestseller.
No, I thank you for hosting it. I enjoyed chatting with you. We used to chat in the old days a lot more frequently than we have recently.
You've been busy been helping run the country the last several years. Well, listen, even some of the Department of Commerce's initiatives, I don't think Biden or his administration canceled any of those tariffs, maybe a few, but I don't.
No, they didn't. They really didn't.
They didn't change any of that. I think a lot of that policy is still in place, but that you and Trump put together. And if he didn't screw around too much with all the regulations, I think a lot of those things are still in place, right?
Yeah.
Yeah. Well, good. Well, listen, that concludes our insightful conversation with Wilbur Ross, offering us a deep dive into commerce and industry and his career. We'll put a link on here, extend our sincere thanks for sharing your insights into your new book, Risks and Returns, discussing your illustrious career and imparting your expertise and vision with us today.
Well, thank you, Roger, for the opportunity.
I'm Roger Aguinaldo. Until next time, keep thriving, keep learning, and keep making deals that matter. Happy dealing. We hope you enjoyed this episode and learned something new from it. If you have any questions or comments for us or any of our guests, please feel free to leave them in the podcast platform of your choice or send us an email at editor@maadvisor.com. We would love to hear from you and get your feedback. And if you haven't done so already, please follow us on Spotify, Apple Podcasts, YouTube, and subscribe to our M&A Alerts newsletter at the links in the description or on our website at www.maadvisor.com. This is Roger Aguinaldo, the creator and founder of the M&A Advisor. Thank you for tuning in and being part of our M&A Advisor community. Until next time, stay safe and happy dealing.